Hello, everybody. It is Tuesday on our 7th week and another special edition of Community Together. And we today have two great guests. Neil Elmouchi from Summit Financial Consultants in Westlake VIllage and Melissa Estrada with Avalan Wealth in Thousand Oaks. So welcome both. And what we're here to talk about today is we're getting a lot of questions that we think is pretty important to be asking. And a lot of people are asking about just kind of how can people get more money given what's going on. A lot of people out there are still kind of waiting for their PPP money, whether it's a small business or an individual waiting for either their unemployment check to come through. So Melissa, why don't you first of all, welcome to both of you. Thank you for being here. We're in week 7, so I just thought it would be good to kind of share your professional and personal knowledge of how you're helping your clients. What are you advising people today in order if they need more money? Where do they go?
Right. So thank you for having me, Lydia. Glad to be on here and such an amazing thing you're doing for the community. A couple of things. I'll start with individuals, first of all. For folks who have had a tremendous impact from the COVID-19 financially, whether it's been furloughed, husbands laid off, spouses laid off, you've lost some income, there is an option through the CARES Act that has changed some of the rules and regulations in accessing a distribution for 401k plans and IRA plans. Typically, withdrawing money out of these qualified retirement plans initiates a 10% penalty automatically and a 20% tax withholding from those monies. So the CARES Act has allowed individuals to access those monies without a 10% penalty or the tax withholding. So they do have access of up to $100,000 from qualified retirement accounts. They will, however, eventually have to pay the taxation on this if it has been contributed to an IRA or 401k. This should always be a last resort because essentially you're kicking the can down the road and dipping into your retirement bucket. So if it's something that's necessary and you need the cash, you can access that money. It does, however, depend on the 401k. It has to be adopted by the plan sponsor. They have to allow these rules to be implemented. With an IRA, individuals can access their IRA money, but will have to pay that tax back either within the year or over the next 3 years. They will be taxing that.
I just want to add a note that it is April 28th, and that is as of today, because as we are seeing CARES Act and everything like that continually changes and evolves, right? So, this is as of today, as of April 28th, if they do pull their 401k money or their IRA, that right now they are going to have to pay the taxes on that if they don't within the year. Right?
Yes, well, they can spread it out over 3 years. So they can, if you access up to the $100,000, you can pay a third of the taxation over the next 3 years, or you can recontribute that money back into the IRA over the 3 years. That it also, to note on there, in addition to that, you have to be a qualified person. So you had to have had some kind of financial impact from COVID, and you have to sign something that says that as you file your taxes.
Wonderful. So, Neil, welcome.
Yeah. Welcome. Thank you for having me.
And from an employer standpoint, what can an employer do to potentially help the employee? Or what do you think, if you want to add on to Melissa on what somebody else could be doing?
Well, one of the big things right now is that if you're an employer, it's cash flow. And it's really figuring out what you need to do for your company. And sometimes you have obligations that you got involved with when you're setting up your company. And you may have had pension plans or the 401k plans, anything that puts an obligation to you with respect to the dollars in the cash flow of that company. So you're looking at how can you improve that situation. And one of the ways is that employers sometimes...
I'm live. I'm sorry. My husband... Sorry about that. This is a live TV show.
Well, that's good. It adds color to the whole thing.
Adds color, right.
So as an employer, one of the things that they do sometimes is safe harbor, and meaning they'll match the amount of money an employee puts into the 401k plan. Well, there's an ability to reduce or eliminate that safe harbor payment. There's some rules you have to follow, and I'm not going to go into those. You need to talk to the pension administrator so that they're set up right. But that can be cash flow, and it can be significant. So there's also the ability to freeze plans now that weren't available before. And what's nice about it is the paperwork doesn't have to be filed in a short deadline. They're actually extending that out, so it doesn't put the employer under a pressure to get all this paperwork done in advance. They just know that if they talk to the administrator and they qualify, they can stop some contributions to the pension plan, which again can be some significant dollars. So they're looking for ways to not only help people as an individual, but redirect those dollars to help maintain their business, make payroll, or cover other expenses.
Really important, because I think a lot of people are still waiting for their PPP or getting approvals or waiting for the second round of money to be coming in from SBA. So if something that, if they haven't thought about, that they can put a stop on some of these other benefits that they're giving their employees, right? And reroute that money, is what you're saying.
Right. And like Melissa said, access, if you're an employer and you need the money to help keep funding your business, or as an individual, that accessibility to up to $100,000 out of a 401k plan is a big deal without incurring all the penalties and restrictions that typically apply.
Good. Anything you want to add to that, Melissa? Anything else as far as like how employees can potentially access some much needed money, and small businesses and operating or getting operating capital, or individuals?
Yeah, I think one of the additional changes within the CARES Act for the qualified retirement plans are taking loans out of the 401ks. This is not available in IRAs, but it is available in 401ks. And now I think they've extended to up to 100% that you can take a loan out, and they've extended the time horizon that you pay that loan back in. So there is access rather than just a distribution where you will pay the taxes or you have to pay the money back into the 401k eventually. You can take a loan on that, and you have a longer period of time to pay that loan back. But again, this should always be last resort. You're dipping into your retirement bucket after all. For folks who are going through an extremely hard time, it's a great availability to them to have some of this cash flow, but just always talk to your advisor, your CPA, and your financial advisor. Analyze the best route to go with this and really understand the consequences that could be coming to you down the line from taking money from your retirement plan.
Yeah, I think the point here is, speak to your wealth advisor and seeing what's important. And if they don't have one, it's probably a really good time to start thinking about getting a wealth advisor, because there's a lot of young families who are moving to the Conejo Valley that really don't have a plan in place and maybe got caught off guard a little bit here on either essentially losing their jobs or, just not nobody was prepared for this, right? Nobody was prepared for
right.
this.
Right. The thing for people, for young families to know, when it comes to Roth IRAs, if you have your Roth IRA more than 5 years, you have access to the contributions in that account, no matter what, always anyhow. So you can take, if you've contributed $1,000 per year over the last 5 years, so there's $5,000 in contributions and say $3,000 in growth, you have access to that $5,000 tax and penalty free. So if there's an option there to be able to access some funds without the repercussions of taxation later on, and it's a minimal amount, then that's also a route for people to take.
But I think one of the big deals right now is just thinking about what you need in the big picture, because having access to these funds is great if you need them. And to take them too early, to do it too fast, just to take it and then all of a sudden money sort of disappears is not good either, because as much as it's great to be able to have access to a 401k, those dollars are extremely valuable to you long term, and that's part of your future retirement plan. And you're also taking money out now, which at a time is more likely that the value of those accounts are down. So if you withdraw money, you're going to be locking in the reduction or the loss that might have taken place in there versus what it was last year. So, it's there, it's available. If you really need it, then absolutely I would say to take it. But if you're just saying, well, I want to take it right now just to have it, that wouldn't be a recommendation I typically would make. And as Melissa was saying too, you really need a plan. It's nice to do this, but you shouldn't be just doing it ad hoc and grabbing things one after the other and just saying, I'm going to take this money and do it. What's the purpose? How is that going to help you? What are you going to spend on? And how are you going to repay it? Because you're not repaying it to somebody else. You're really repaying it back to yourself. And that's really important dollars.
Yeah, and there are things that can get delayed, rent, mortgage payments. There are things right now that we've talked about previously that you can get delayed before potentially you have to take money out. So there are other ways that potentially they could speak to an advisor and speak to somebody to talk about what are the other options before they do that. You mentioned something about that I'd love to move to, kind of the market, right? We've seen a lot of up and down in this market. And there are people who are opportunistic and looking at the opportunities that potentially are coming in the market that have used an advisor and have set themselves up. And there are those people also that are saying, what opportunities are there in this market for me to move forward? And that could be young families, it could be older families, it could be, I would love to hear both of you perspective on what you think somebody should be doing. What are you telling your clients today who potentially aren't in that position and potentially have money saved and wanting the opportunity?
Well, I'll start off by just saying that it depends. It's because there's not a one size fits all. And if you break it up into what I would tell somebody in their 20s versus 30s versus 50s versus 80s, it's going to be across the board. It's the risk tolerance. It's having, back to what we started with before, a plan. But yes, there's a potential for some very good opportunities if somebody's patient, if somebody understands it and just doesn't throw money out at it, but has some guidance, then and knows that they want to do this. But you're looking at time frames of the next 2 years, 3 years, 5 years, could be 10 years. And but you say, you know what? You can make a great investment today that becomes an overnight success 10 years from now. It's just like people want it to happen immediately. Sometimes you could, and sometimes it may not work that way. But if you got the patience and a plan, chances are you can, do something that if you've got the time and willing to wait for it, it can work for your benefit.
Yeah.
Right.
Melissa.
Right. I will just say to add on to what Neil said, absolutely. Review is my advice to people. You could be well positioned within your portfolio to withstand this market, but if you're feeling uneasy, if you're not comfortable where the portfolio is gone, you should make sure that you have identified what structure your portfolio should look like right now. So a couple of things you should have through a financial plan comes the identification of what your goal rate of return is. And once you identify that, you take a look at your risk tolerance, compare that to the level of risk you're taking, and see if it matches up. A lot of people don't go into portfolio construction, especially if they only have 401ks, with a financial plan. So they haven't identified their objectives, their goal rate of return, their savings amount. This is when you should have that going forward so that you can use deductive reasoning from that plan and back into what your portfolio should be taking on. In addition to that, with a plan, have you counted in for a downturn like this? Were you prepared for this? With some of my clients who, as Noel was saying, it depends on the stage in life. So with some of my clients who are retired or preparing to retire, we were prepared for a downturn. We had extra, we were a little overweight in cash, so because the industry in general has been waiting for a natural correction. Not that anybody could have predicted this COVID pandemic, but now's the time for us to strategically look at how we're going to move forward with the implication of some of that overweight in cash. So it all comes down to a financial plan, knowing what you're trying to hit as far as return, knowing when you're going to start taking that money out, and knowing how comfortable you are with volatility.
Yeah, I'm going to add on one other thing with debt. And when we're talking about cash flow before for people, one thing that a lot of people don't really pay attention to, at least usually not a good enough analysis, is debt evaluation. And that's if somebody's having problems, cash flow's not there, and they're not getting the money they had before, they're laid off, whatever it might be, but they have bills coming in. And all debt is not equal. And if I have a credit card that's going to charge me 18, 20%, 22% if I don't pay that bill, that may be more important than paying another bill that's I'm going to be charged 2% or 3% if I'm delayed. So they need to go through and evaluate the different types of bills they are paying. And this is where, when we were talking about before, accessing your IRA money or your 401k, if it's taking it out to avoid getting a 22%, annualized charge on it through a credit card, then you need to seriously look at that, because that could make perfect sense. And one last comment I want to make, because I didn't know if we were getting on it, with the RMDs, required minimum distributions from the 401ks or your what could be that could be your IRAs. That is being delayed. So that's more for people who don't need the money, but RMDs require you to take it out annually and then be taxed on it. If you don't need it, you're given the ability to delay it till next year, and that's actually a big deal for a lot of clients.
That's good to know. Yeah. So I just got a text. Will either one of you share 3 secrets about if you're going to invest in something today, where would you put your money? They're like, if you get anybody to tell you anything.
Yeah. Here's this. I will share three of my investments. If you want to give me a call, I'd be happy to share them over the phone to evaluate your situation. Yeah, we have to be very careful in identifying individual investments, because it might not be suitable for everybody listening. What I do for one client who is accumulating wealth and what I do for a client who's distributing wealth are 2 completely different investment strategies. Yeah. So we have to be careful with what everybody wants to do with their money.
Yeah, I couldn't say it better. We do the same thing. You just can't. It's not a one size fits all.
Well, as pure professionals that you are, we couldn't break you. So anything else you want to share from an investment? Obviously, getting a plan, having a professional like you behind them, and being able to talk it through and know their strategy is super important. But you did share some great tips on how people who do need access for money right now, and that is pretty important from both an employer and employee side. Anything else you want to add as we wrap this up?
I would just tell people that if you're, just monitor what you're doing. Do it closely. Look at it in a way that you're saying, okay, I've got my bills, I've got my so much income, and manage it in a very precise, detailed way so you can get a good feel for what it is, not just randomly pay bills just because that one happened to come earlier than another one. It may not be in your best interest. And a lot of things, unfortunately, in this environment, people are not paying as quickly as they have been normally, and a lot of companies are maybe forgiving the delayed payment that might come into play, like an extra charge, because it's just the cash flow is not there. Everybody understands what's going on, and talk to the people that you do have bills coming in from to see what arrangements they're making, because you can't be the only one that's probably calling them.
Right. Very true. Melissa, anything you want to add?
Yeah, I have a great point, Neil. I reiterate everything he said. I'll add from a market and economic standpoint, when our investment policy committee is getting together, we really truly understand that this is a very difficult time. It's awfully scary, but we do think that we will recover from it. We do see a W-type recovery coming. We think there'll be a ton of volatility over the next 6 months or so, but that creates a ton of opportunity. So if you're in the position now, go get the plan, definitely. Make sure you're reevaluating your portfolio, making the necessary moves so that you can take advantage of some of what's going on. And in 3 or 5 years, you'll be happy that you made those moves.
Yeah.
Right.
So really good advice, really good. Thank you both for sharing your knowledge and being so professional, and just really good for your clients and serving your clients and serving the community. So thank you for coming on today and sharing. Thank you again so much. Enjoy your
Thank you for having us.
Thank you.
Bye-bye.
Bye.